I want to start by just keeping things really simple. I mean, I do this with my presentation, just the real key takeaways. If I had to have a title today, it would be buy gold and sell commodities, given where we're going with respect to the economic cycle. I mean, where we are right now, where I think we're going over the next 12 months. So the things I'm going to talk about and the things I think you should remember are, if we're going into a recession, which I think we are, you want to buy gold and sell commodities. That's when gold performs the best. Obviously, gold's correcting right now, so I threw in a potential target. There's a lot of support in the mid-1800s, so rather than just say buy gold right now, I'll say buy gold in the mid-1800s, sell commodities. Secondly, the timing of the recession is really critical because that's probably going to coincide with when the Fed has to shift policy and ease, and that's likely to be the catalyst for gold specifically to make that big breakout. Then the rest of precious metals start following suit, start outperforming. So the timing of the recession is really key. We'll get into that. I'm giving myself a big range here. So it could be in the fall, or maybe it's delayed a little bit, could be in the winter. And lastly, I'll talk a little bit about silver in the last third of my presentation. But you want to buy silver when gold breaks above 2050. Okay, so we're still awaiting this big picture secular change. And so historically, if gold goes into a secular bull market, the stock market goes into a secular bear. And so I have gold stocks up here because they help paint the picture, because we were on the gold standard for so long. So gold stocks did well in the 30s, also in the 60s and 70s. And so, I mean, I could talk more. I'm not going to talk that much about the stock market today, but I mean, it's bounced off the 40-month moving average several times, and that's kind of my demarcation line as far as where the secular trend is. But if we do have a recession later this year, then we'll probably see the stock market fall below that line, and then we're into this secular trend change. And obviously gold's been, I mean, it's knocking on the door. It's getting really close to that major breakout. It's pulling back now. I think it's going to pull back more. But also, I mean, there's a lot of similarities to the mid to late 60s. And so this is when gold stocks broke out. So interestingly, the 68, 69 was when the secular bear began for the stock market. But the 1960s, it really slowed down. And so if you're looking in real terms, it was really 64 when the gold stocks here, when here they had this big breakout. That was really, at least in real terms, when the secular bull in stocks ended. So the reason I'm pointing this out is it is possible for the gold to have this big breakout, and then maybe after the recession, the stock market recovers and it makes a new high, but it's really not that great. So it's kind of a repeat of the mid to late 60s. So those are just a couple things I'm playing around with. And here's another thing. I mean, this is more subjective than objective, but thinking about the big picture change, there's several similarities between where gold is right now and where the stock market was in the early 80s. And so, at this point, you have two secular bears here, one secular bull, so same thing. I mean, a lot of people say, well, this new secular bull began in 2015, 2016 for gold, but that's not true. It's not true in real terms because the stock market has performed too well. And if you look at the rest of the sector, silver and the gold stocks, I mean, yes, they're up since 2015, but they haven't really done that great. So in my opinion, the secular bull has not started yet. And you could say the same thing here with the stock market. I mean, it had this 74 low, but 82 is really when the secular bull began, and that was because that's when it began in real terms. It made this bottom here, but commodities were still outperforming in the late 70s into 1980. Just like, yes, I mean, we've had this bottom in gold, to a lesser degree, precious metals as a whole, but they've underperformed the stock market. So when precious metals get into a real secular bull, they're outperforming everything. And so we're not there yet because they haven't been outperforming the stock market. And so think of this period in the stock market, here, the Great Depression. For gold, I mean, not the entire industry, but for the gold price, I mean, this was really a Great Depression here, the secular bear. And then it took gold 28 years after that to make a new all-time high. For the S&P, it took 26 years to best the 1920 high. And then at this low here, gold was up 100%, which seems like a lot, but that's only in a 45-year period. Same thing for gold here. This low, it was only up 30% above the 1980 high, 36 years. So a long period. And then, I mean, I touched on this a little bit. This period is similar, very similar to this period. And so even here, the S&P, it made a new high here, I think, in late 80 or 1981, but then it corrected. And so even though you can say it broke out here, it wasn't until 82 when it really got going in real terms. And so the same thing with gold. Well, gold's above the old high, but it hasn't really broken out yet. It hasn't run away. It hasn't broken out in real terms. So there's a lot of similarities. And so just two other points, because I don't want to drone on forever, but in the late 70s, early 80s, so you had the stock market was near an all-time high, but the sentiment was bad. I mean, most people were out of the market. They didn't own stocks. They were into commodities or whatever. Stocks were an afterthought. Yet that was going on while the market was near an all-time high and just very close to having this huge breakout. Then it had this huge breakout, and of course, stocks became mainstream. And I'm not saying gold's going to have a 20-year bull market after it breaks out. Probably 10 or 12 or something like that. But in terms of sentiment and like the mass appeal, assuming gold breaks out, makes this big run in the next 3-5 years, then it's going to become more of a mainstream investment the way stocks became in the 80s and 90s. So this is interesting. There's just a lot of similarities here. And for gold, we're correcting, we haven't broken out yet, and so sentiment is not great. So that's really they're just one of several key similarities. So circling back to the present, where we are now. I talk about it I was going to say way too often, but that's because it's so important. Gold against the stock market. For gold to break above 2100 or 2050, it's going to have to break this resistance against the stock market. Gold against foreign currencies here, another way of looking at this calculation is gold multiplied by the US dollar index. And so I love this chart because it's just removing the dollar and dollar weakness. So kind of in like constant currency terms, how is this performing? It also tends to lead the gold price. So you take out the dollar, gold against foreign currencies, it's correcting like everything else, but I mean you can see it's above the 20 high, above the 22 high. So it's stronger than gold. And yes, it usually leads gold. Gold against bonds, you can see that's in a nice uptrend. Gold against commodities, trend change here. Now it's outperforming. The moving average is rising. Technical tip, the slope and the direction of the moving averages is really important. And so, coming back to gold against the stock market, for gold to break out above 2050 or 2100, it has to break out. This ratio has to break out to the upside. Like that's been the missing thing to get into a real secular bull market. And that's why the macro, which I'll talk about, that goes with it, is so important. So this is just simple, but this is looking at GDX against the other commodity stock ETFs. XME, I think that's a broad mining stocks ETF. And you have XLE, which is energy stocks, and COPX is copper stocks, and URNM is uranium stocks. And this is really useful. I mean, you should also do this with your stocks and look at your stocks and see how they're performing against each other. And so if we're looking at GDX right now, the chart's kind of ugly. The short term's not so great. But if you look at gold stocks against all the other commodity stocks, as you can see here, they're outperforming. So in real terms, gold stocks against commodity stocks have made a bottom and they're trending up, pretty nicely. And so, and given where we're going with the macro, like if you can look at this chart, and the problem with a lot of technical analysts is they only look at the charts. They don't consider the other information, like the macro that goes with it. And so, you can look at this chart, but at the same time, if you really think the economy is going into recession, then it's not a good picture for commodity stocks, for uranium stocks, copper stocks, energy stocks as a whole. So I'm not trying to disagree with anybody on purpose, but it's probably nice to provide, here it's nice for me to say something that not everybody here will probably say, but I would, and I personally do think we're going to a recession. So considering that and considering the technicals, this is not the time to be in, uranium stocks, copper stocks. I mean, everybody's bullish on those. You do your research on the stocks, but forget about those for, probably 9 months, maybe 12 months. They're probably going to go lower. And so, before I get into the macro, this is another interesting chart for gold. I mean, gold has this super bullish cup and handle pattern, and it's taking a little while for it to break out, which is fine. But, I like looking at, we have this is a weekly chart. So these moving averages, we have everything from like a 200-day all the way up to a 40 month. And so I'm just looking at the weekly equivalents. And so it's interesting because you can plot a bunch of different moving averages, and you can see when they kind of coalesce together, these 4 different points. I mean, the main 3 were here. I mean, the other 2 historically are this one. But when you have all these moving averages coalescing together in a really tight space, not only does it provide support for the market, but it's also an indication that a big move could be coming. And so if you look at the bottom, that's just it's looking at the width of Bollinger Bands. And so it's just a volatility indicator. That's all you need to know. And when it's really low or declining, it tends to precede big moves. And so we can see where we are here. It's similar to the other 3 times. And I would say we're most similar to here, in my opinion. The interesting thing is here, this was kind of similar to this because the market was well below the all-time high, and long term you can still draw a down trend line. But where we are now, this is in a position of long-term strength. It's in a much stronger position than all these other things. And so going back to 2019, when this move started and it broke out, I think it went up 65% in like 15 months. So if, let's say gold pulls back to the mid-1800s, a 65% move in 15 months is 3,000. So, and I think it's going to, when it breaks out, I think it's going to be an even more powerful move than that. But that comes down to the question of when is it going to break out? But when it does, it's assuming it's, in the coming months and next year or so, it's going to be really huge. It's going to be a vertical move. So getting into some of the macro, and I'm not an economist, so I'm just going to try and keep this really simple. But these are just a couple charts that look at yield curves. And so there's various different yield curves you can look at. This one looks at the 10-year and the 3-month, and then it uses the 50-day moving average to smooth it out. And if you look here, you can see, I think the median time of all these inversions to when the recession hits, that puts us in September. And since 1966, all of these signals have been correct. After all these inversions, there's been a recession. So this is a really powerful signal that we have. And again, the median time historically of when the recession would hit would be September or begin. And so this is another yield curve. I think this is one that the Fed looks at. It's like a forward spread between the 18-month and then the 3-month forward rate. And so, again, this is another one. The median time of when the recession could hit or begin would be September. Here's another one. This, I think, is a better chart because this looks at the 10 the spread between the 10-year and the 3-month, and then the number of months to the beginning of the recession. So again, I think the median of this, and this doesn't show all the instances of the inversions, but we're in the 7th month now, and so the median, again, it puts us in September, but if you look here, I mean, there's several instances of 12 months, 14, 14, 17. So, I mean, another 12 months, if it took 12 months, that wouldn't be that out of whack historically. So 5 months from now, I mean, that almost puts us into November. So that's why at the beginning I said, the recession could hit in the fall or the winter. I think, that pretty much covers the entire timeline. But that to me, I think, is the interesting question, is when the recession is going to hit. Might it hit later, like in the winter, and not in September in the fall, like a lot of things are pointing to? So I think that's the key question, not if there's going to be a recession. It's just when it takes time for it to happen, and there's all this talk about a soft landing, and people forget about it. And so that's just something we have to be mindful of. And so the real best signal for a recession, aside from the yield curve, but kind of like an immediate signal, is if you look at the bottom here, you have the spread between the 10-year and then the 2-year yield. The 2-year yield is a proxy for the Fed. It's kind of more of a long-term proxy. But when we get to the point where we see this big drop in the 2-year yield, and then at the bottom, because of that, the yield curve really steepens and it goes back above zero, that's going to be the signal that the recession is really imminent. Now, in the short term, we can see, bond yields are rebounding. This yield curve it's further inverted. I mean, it was steepening a little bit. Now it's further inverting. So we're going the other way right now. And I mean, I don't know. Maybe that can last a couple months. But that's the real takeaway to look for is when. So we have this move where yields are going up. Maybe the Fed can hike 1 or 2 more times. But when the market goes the other way and it happens really, swiftly, and there's real momentum behind it, then what would accompany that is, you get the 2-year yield having this big drop, and then the yield curve would steepen at the same time. So again, we're not there yet, but this is one, signal we can keep an eye on that's really like an immediate indicator for a recession. And so finally, I'll just close with silver. And I've been doing a lot of research on silver recently. And, we hear this talk about silver. Well, it's a precious metal and it's an industrial metal. That is true. It's an industrial metal. But the way that silver performs, it performs entirely like a precious metal, but like a highly leveraged play on gold. So, and again, I'm not trying to disagree with anyone, personally or on purpose. But in all the industrial stuff for silver, like the supply and demand, all that, it's just not. It doesn't mean anything as far as the silver price. As far as how silver moves, it's just entirely. It just follows gold. And so when gold's doing really well, silver will do well. If gold's doing okay, silver won't do as well. And so looking here, we can see these vertical lines are just 5 of the biggest breakouts in gold. And so I highlighted some of the moves in silver. And so all the biggest moves in silver basically follow breakouts in gold. And here there were this was a breakout as well. I think it's when gold went above 300. But yeah, so there's no way silver is going to make a big move without gold. And so just one more thing on silver, which is really interesting. You look at all these big breakouts in gold, and silver had a similar breakout, but it came after the gold breakout. So, here, this was a breakout in gold in the early 70s. I'm colorblind, so I can't tell what these colors are from here, but these red arrows are when silver broke it. So this is when gold broke out. This is when silver started to break out. This is a gold-silver ratio down here. So we can see, and then this one too, the gold breakout happened first, silver breakout happened next, and, around the time, around here is when silver started outperforming gold. And the same thing happened in the 2000s. So the blue are gold breakouts. The other line are the silver breakouts. And so we can see, gold breaks out, then silver. And again, this is the silver divided by gold ratio. So how does that apply to where we are now? Well, I'll mention that when we get to number 3. Wrapping up here because I'm a little over time. But again, the 3 things to remember right now. This is I'd say buy gold at 1860. So buy gold when it corrects into the mid 1800s. Sell commodities. Commodities are going to underperform gold. I mean, definitely if a recession is coming. And I do think a recession is coming. September, I think, is one month where it could start, but it could start as late as in Q4 and even the winter. And then finally, given what we just saw with respect to silver, so gold it will have its big breakout first. It'll break 2050, 2100, and then run. The silver breakout above 28 to 30 will come after that. So when it looks like gold's going to break out, that's the time to buy silver before it breaks out. But silver is not really going to outperform and really lead, until after gold breaks above 2100 and starts moving. So that's all for me.